there's going to be times when the market really provides us an opportunistic time to take action in the market and trade with price action and have very little resistance in our trades. And obviously that comes by way of trading in low resistance liquidity runs. A low resistance liquidity run would be in the form of something similar to this. Now, these crude depictions, while they are rather elementary in the way that they're being shown here, the concept is very easy to see in price action, as we'll look at when we get done looking at the actual crude diagrams I've shared here. If we see the market come off of an old high, okay, and it comes down rather quickly, if there is a very sharp or one-way type direction, very little retracements of any kind, when we see this, okay, once that market breaks below an old low, from that point at which it breaks the old low until it gets through a short-term high, in other words, the market comes down, makes a low here, starts to trade off, comes down, makes a higher low. Once it starts running through, if we get a market break through this short-term high, this run here begins its climb back up into the range that's created by this low being broken. So it's being defined by this level here all the way down to this high once it's broken. This area of price action is deemed low resistance. Now, every time that a new short-term high is formed, before this low is retraded to or retested as resistance, every time there's a new short-term high, what's going to form above that short-term high? It's going to have buy stop liquidity. So buy side liquidity is going to be above these old highs. If we get a buy signal after a retracement, we know that there's going to be very little resistance for that move to go higher, running out the buy stops just above these short-term highs. As we get closer to coming up into hitting this low that's been violated here, then we start encountering high resistance liquidity runs. So the probabilities fall off precipitously once we get back to the area at which the range is defined in terms of low resistance. And then it becomes a high resistance liquidity run. To make any higher highs or run on higher highs, it becomes a lot more resistance to do that because we move back into an area where the market has moved in a range. This expansion, okay, that's the easiest part of trading when we can trade inside that range. So every time we create another short-term high in here, if we get a buy signal, that buy signal will have very little resistance to get through the old high that it retraced from. And you continuously look for those until you fill in that break on this old low. Once it gets back to this old low over here, the market goes into what is referred to as a high resistance liquidity run. Anything higher than this price point here becomes a high resistance liquidity run.